Hello and welcome. You're watching the business wrap-up now, and markets held on to steady gains after a lower open. The indices snapped 2 days of losses to end higher in trade. Metal and IT sectors advanced, whereas FMCG and healthcare shares declined. Alex Matthew with the wrap of all the market action.
It's a positive start to trade for the equity markets in India. The Nifty 50 gaining ground towards the end of the session to end with gains of about 0.5%. In fact, we ended very close to the high point of the day's range. You had the broader markets that outperformed the benchmark indices and gained about 1% each for the Nifty mid-cap as well as the small-cap index. And this is likely on the back of the risk-on sentiment that you can see across global markets, possibly on account of expectations in China that the government will walk the talk on the stimulus measures that have been spoken about in the recent past to bolster that economy where growth has been flagging. The natural beneficiaries of better growth in China would be the commodities players, and that was borne out in trade in India as well, with the metal pack outperforming. The Nifty metal index gaining about 1.7% or in fact more than that in trade today. But you also saw the Nifty IT index gain ground. It ended with gains of about 1.5%. You had the banking pack that was up about 0.4% as well. The two underperformers were the Nifty healthcare index as well as the FMCG index, which both lost ground. The heavyweights lent quite a bit of support. You had Reliance Industries as well as TCS Infosys gaining. But among the top gainers, you had NTPC, ONGC, Power Grid Corporation, Adani Ports as well as Hindalco gain ground. On the losing end, you had Apollo Hospitals, which was the worst performer, followed by Britannia, HDFC Life, Divi's Laboratories as well as Bajaj Finance. A few special mentions. Kotak Mahindra Bank lost ground after a Bloomberg report that suggested that the RBI has nudged the bank to find a successor to Uday Kotak from outside of the bank. The bank has denied that report and said no such communication has been received. You had NTPC, which I mentioned at the start. It hit an all-time high after net profit gained over 20%. And you had Nazara Technologies. We spoke to the management and the company has posted a growth of about 30% in its net profit on a year-on-year basis, but it has guided to a significant improvement in operations over the course of the rest of the financial year. All told, it's a good start to the week as I mentioned. Let's see how that pans out.
While the Indian markets have seen a bull run in the recent days, what lies ahead for equities? BQ Prime spoke to Sanjay Mukam of JP Morgan, who shares his view on the performance of Indian markets in the next 6 to 8 months.
If you look at 25-year history in the country, decoupling of Indian equities has happened maybe 2 or 3 times, and that has required significant events to happen. So let's say big election surprises or the COVID reopening. Those are the few instances where India has temporarily disconnected or decoupled, as people use, from the global equity sentiment. We don't see such an event in the next 6 to 9 months. I mean, yes, we are heading into elections, but that probably increases uncertainty. So if you then ask for decoupling, you probably see a downward decoupling if elections become a topic of conversation in India to begin with. So we're not saying that India should underperform EM. There is no concerns to that extent as well in the next 6 to 9 months, but it is unlikely that we'll decouple to the upside as well if global equities were to come under pressure.
BQ Prime's new show, Neeraj Shah speaks to the co-founders of Neo Asset Management about alternative investment. So are equities the only game in town? Do alternatives give a strong option for non-equity seekers? Hear out Hemant Adaga of Neo Asset Management.
Private credit, lot of asset managers entering. There is a lot of space for many. Real assets, I still think more domestic managers need to enter the fray. Currently, it's a space dominated by the large global pension funds. They've been here in India for the last 10 years. They've made healthy returns. I think if you look at some of the exits some of these guys have done, 18% annualized returns over 6 years on platforms they have built. But now is the time for domestic asset managers to enter and showcase it to domestic customers. This is a conversation we keep having. I think the world of SIP has changed Indian equity markets and Indian mutual funds forever. We think in alternatives, the next 10-15 years is a phase where Indian money will change the world of alternatives. We need our savings to come and channelize these savings into these instruments. so that it can be productively channelized into buying roads and transmission lines and data centers and lending to companies. And that is what we want to do at Neo. We want to channelize long-term savings of our customers into some of these highly productive assets.
A steady June quarter earnings led to IDFC First Bank rallying in trade today. The bank's net profit rose by 61% year-on-year. The asset quality also improved in the quarter. Moreover, the bank's board approved raising 3,000 crore rupees. BQ Prime spoke with V. Vaidyanathan of IDFC. Listen in.
You're going to raise about 3,000 crore through equity fundraising. Your capital adequacy is a strong 17% at this point in time. What is this capital going to be used for coming in the coming few years?
So this capital, we may not raise it immediately. We've taken, because we have an AGM coming up next month. So we thought it's a very good opportunity for us to actually put out a resolution, take the shareholder approval today, so that it stays enabling for 1 year. So so that we don't have to go to the shareholder at that point of time, when we want to raise capital. So think of like an enabling, take the opportunity of the AGM. And the second thing is that probably by end of this year, we'll certainly raise this. So so we still have maybe 7 or 8, 9 months to go.
Shares of Pyramal Enterprises plunged in trade today following the announcement of share buyback and the release of June quarter results. The company has said it's evaluating potential merger and acquisition opportunities in small business lending, microfinance segments. BQ Prime spoke to Pyramal Group Chairman Ajay Pyramal.
In unsecured loans, there is risk has increased, and therefore we have also tightened up our areas. So we do have unsecured loans as well, which is a small proportion of our book today, and we have tightened up our lending there. So all the parameters that we use for lending, they have been tightened further so that whatever risk is, that we will be able to take care of it.
Mr. Pyramal, how is the integration of the DHFL loan book going? Have you been able to integrate fully and maybe sell off some of them as well?
So the integration has been pretty successful. We will be almost completing, now we'll be completing 2 years by the end of September. And I think it's on track. We've been able to, the integration as far as the people is concerned, as far as technology is concerned, is there. Collection of the book continues. Some of the book, as far as the wholesale loans are concerned, it is a challenge because those were difficult loans, but we are not even, there was no significant value that we had attached to them. So I think we will be fine with that. The retail loans, which we are collecting them as per what we think, and actually we are pretty happy with the integration.
Reltel reported a double-digit rise in its profit and revenue in Q1. The company's order book stood at over 4,500 crore. Reltel has planned a capex of nearly 158 crore rupees in financial year 24. BQ Prime spoke to Sanjay Kumar of Reltel, who is of the view that the company's revenues could touch 5 times in 5 years. Listen in.
So if you talk of next 5 years, I can, if my plans, my team's hard work is really working, I'm sure that we should cross at least 10K number, 10,000 numbers, 10,000 crore by within next 5 years.
You're talking about annual revenue size?
Yes.
Okay. And with this large execution and ordering and revenues, would operating leverage come into play? I'm trying to understand, or would you kind of operate at the similar kind of operational metrics?
We see, because projects segment will increase, and telecom as a part of total kitty will be much lesser. So naturally, our operating numbers, if we talk of EBITDA or PAT, all those numbers will certainly get affected, because any projects, it's very difficult to take them 6 to 7, 8% beyond. So certainly our EBITDA margins will come down.
Though Chalet Hotels reported a strong set of numbers, they were below street estimates. While net profit surged over 200%, revenue and margins were below estimates. BQ Prime spoke to MD and CEO of Chalet Hotels, Sanjay Sethi.
A large part of the capex that we've invested in is in the 2 office assets. And we expect the IRRs, project IRRs to be in the range of 20% plus. And ROCs to be in the high teens. Then there's some couple of hotel assets. The Hyderabad one that we recently opened. We've got around a Delhi asset that's under construction. We've got 88 new rooms at Pune, 130 rooms coming up at Bangalore. And we'll have the Airoli Hotel, which is a Hyatt Regency. Combined together in our feasibility studies, we were expecting to hit mid to high teens in terms of project IRRs. And equity IRRs in excess of 20%. But with the markets improving and the rates improving, we expect that to go northwards from there onwards.
And that's a wrap of all the business news.